Good morning, everyone, and welcome to today's webinar. Uh, we have today we're discussing a topic that we've covered a number of times over the last few years, which is municipal bond data and analytics. This is an area that up until relatively recently, a few years ago, there wasn't really much going on in this space. It was a relatively sleepy market. But over the last few years, we've actually seen quite a lot of changes in terms of market consolidation between different vendors that are operating in the market, and in terms of new developments and innovations within the marketplace. So it's an area, given that there's quite a lot of change going on, it's an area that we've been monitoring quite closely over the last few years, and periodically updating the industry and our clients on what's going on in this space. So today we have, in common with our usual format, we have a number of experts in the industry to talk about some key topics that are currently going on in this area. One of you should all see today's agenda up in front of you now. I'm giving, obviously, a brief welcome. My name is Ian Blance, and I'm the Managing Director of Voltaire Advisors, who many of you will already know. We then have Andy Callate from Callate Analytics, who is going to talk a little bit about the work that they've been doing in terms of taxable munis, and specifically callable taxable munis, and what kind of value that produces. Then we have Unmesh Bida from JP Morgan Pricing Direct. Unmesh is going to be talking about a new development of theirs, which is the use of machine learning, and specifically in the area of muni bond pricing. And then our final presenter is Robert Kane, who's the CEO of BondView, and Robert's going to be talking about the work that they've been doing in terms of liquidity and indices. And I believe he's got a very topical COVID-related aspect to the presentation as well. So that's the running order for today. There'll be some opportunity towards the end of the presentation for a level of audience Q&A. And for those of you who haven't participated in any of our webinars before, you will just a brief sort of piece of housekeeping on what's the audience Q&A, how the audience Q&A works. So you will see in your webinar system that there's the ability to submit questions in writing, and that's the way we'll be taking all the Q&A. Feel free to submit a question at any stage during the presentations, but be aware that what we will do is we'll save them all up, and what we'll do at the end of the session is to try to cover as many of the questions that have arisen as we can. And we'll do that in terms of a moderated session that I will actually look at. So we're looking to close at around about 11 o'clock today, and we'll try to fit as many of those questions in as we possibly can. So just another little bit of housekeeping. One of the questions we always get is, will we be distributing the slides and recording? And the answer to that is yes, we will be. And as soon as it's all loaded up, you should get that within probably tomorrow, when we've got the whole thing loaded up into the system. So yes, you will get a copy of the slide deck and a copy of the recording, and that will probably be available tomorrow. So without too much further ado, what I'd like to do now is hand over to Andrew Callate. Andy's bio and is in the event page for those of you who've managed to see it. So without any additional delay, I'd like to hand over to Andy. Andy, if you'd like to take over and do your presentation.
Thanks very much, Ian. So if you're involved with munis, and I assume just about everybody in the group is, you probably heard about the large volume of taxables. During the first quarter of this year, roughly 1/4 of new units were taxable, and expectations are that there will be quite a few more munis issued the remainder of the year. Most of these munis are issued as for refunding purposes, and that's what I'm going to be discussing. Hang on, I have some trouble running.
You're looking to go back, Andy?
Yeah, I'd like to go back. Exactly.
Doing it for you.
Exactly. Thanks very much. I have control here, right? Yeah.
You do? Yes. Yeah. Yeah.
Okay. I don't know why I jumped. Just a few words about Calote. We've been around since 1990. We turned 30 in April of this year. We focus on fixed income, investment grade fixed income, a lot of work with options. And my particular interest is looking at bonds from different perspectives. So, for example, in the case of munis, you have issuers who do not pay taxes and investors who do pay taxes on capital gains or capital losses. And this asymmetry creates some interesting situations. The topic I'll be discussing today has to do with taxes, because municipalities can issue both tax-exempt bonds and taxable bonds, and how do they look at these bonds separately? So I'm not going to say too much about our analytics, but I do want to mention speed, which is becoming an issue now. We hear more and more about real time. I just want to add that we do about 1 million callable munis per minute. We have some demos at the end that you can look at and see it for yourself. I do want to mention one more thing that should be of interest to this audience, which is our tax neutral valuation. This has to do with the proper valuation of discount munis, the so-called de minimis effect. The point being that once a muni goes to a discount, its price is depressed because of the tax payable by the marginal buyer. And if you use standard analytics, you are going to underestimate the duration of a discount muni, sometimes by a very large margin. You overestimate the option-adjusted spread, and so on. Again, we have a demo that you may want to look at and see it for yourself. Let me Ian, I have trouble moving forward.
Yeah, there you go. Just shout out to me, Andy, if you need to move the slides on.
Okay, so let's set the stage. Thanks again. And so the issue, just before we get into the specifics of these taxable munis, how do they come about? You have to know a little bit about the infrastructure of the muni market and the current practices. And first and foremost, the 5% munis with a par call in year 10 have been the standard for many years. And you say, well, why do we need 5% and why should they be callable at par? Well, there's a good reason for the 5%, because institutional investors would be hurt in terms of performance once a muni goes to a discount because of this de minimis effect. So selling a bond at a premium minimizes the probability that the bond will go to a discount. What about this par call? And the par call is really, in my opinion, is really not necessary. In fact, what happens if you sell a 5% bond with a par call, you're virtually guaranteed that it's going to be called. And because the coupon, the 5% coupon, is way above prevailing interest rates. And that's exactly what used to happen prior to 2018. The bonds would never even make it to the call date. Most munis would get advance refunded, and that was the practice. By the way, looking at the refund is from the perspective of the issuers. They love savings. So the 5% bond would serve this very nicely. You would advance refund the 5% bond and show 15-20% savings easily. Well, that stopped at the end of 2017 because the tax laws changed, and today you cannot issue a tax-exempt bond to advance refund a not yet callable tax-exempt bond. Today, only a single tax-exempt issue can support a project. However, we still have roughly 400 billion of high coupon, 4.5%, 5% bonds, unis, tax-exempt. They have not been advance refunded, and they will become callable in the next few years. So if you're an issuer, you may say, well, what can we do today to show some savings? And this brings me to the topic I'll be discussing. Ian, thanks very much, move forward.
You did that one.
There are several ways of, several methods have been suggested. I just mentioned a couple of them that you may have heard of: the Cinderella bonds, the forward contracts. They're all to advance refund currently tax-exempt bonds. But the one I'll be discussing today is the using taxable bonds to refund not yet callable tax-exempt bonds. And they do provide huge savings. Again, you can easily, what's happening, the tax-exempt rates are roughly 3%, the taxable rates are 3%, the outstanding tax-exempt bonds have 5% coupons. So we show huge savings. If we could refund these tax-exempt bonds, it would be great, but we cannot do it because only one tax-exempt issue is allowed today. The problem is that, as common sense tells you, that it would be preferable to wait until the call date and refund these tax-exempt bonds. You leave a lot of money on the table. One way to see it, if you're a quant, is to say, what's the value of the call option that I forfeit today by using tax-exempt bonds? And when everything is said and done, you find that you extract only about 70% of the call option. You leave 30% of the table on the table. One interesting question is, who gets this 30%? You may want to think about it, but I will not discuss it today. In any case, once you lock in a tax-exempt bond, a taxable bond for a long time, you're done, and you can take advantage of tax-exempt rates going forward. But the question is, what if you use callable taxable bonds, which is the topic I'll be discussing? Now, if you have a taxable bond, which is also callable, the coupon is going to be higher, but you will have a chance to refund this taxable bond, these tax-exempt bonds, once you have called the outstanding tax-exempt bonds. And that's the story. That's the topic I'll be discussing. So, Ian, could you go to the next one, please?
Sure.
All right. If you look at some of these callable tax-exempt bonds, you find that they are priced very much like other callable taxable bonds, taxable corporates. So, for example, if you look today, if you wanted to issue a 20-year muni callable after 10 years at par, which is the standard feature of these standard call provision of these callable munis, you'd pay up for about roughly 20 basis points, which is in line of what you would be paying for a like corporate callable. But the main point of my presentation, the key takeaway for you, is that these taxable callable bonds will not be refunded by taxable. And how do we know they will not be refunded? Because the issuer will be able to use tax-exempt bonds, and the issuer's tax-exempt rates are always lower than the taxable rates. So this is a very interesting situation, very unusual situation, where we are actually looking at two different yield curves. On the one hand, the taxable bonds are priced, the bullet part is priced on the taxable rates, but the option, which is the key consideration here, depends on the tax-exempt rates. How do we value this bond? It's tricky. You can't just put it into a standard OES. The standard OES has only a single yield curve. It doesn't have two different yield curves. So I'm just going to give you some results for these, getting into the specifics of the valuation. But I would like you to have a sense of how much value you can extract from these taxable callable munis. Ian, if you could go forward. Okay. I'm going to give you an example, which is out of a paper that has not been published yet. I can send it to you if you're interested. The story begins with, pretend that today you have a tax-exempt bond. It has 22 years to go. It is 2 years to call. And you refund that today is a 3.25% taxable muni, which is callable in 10 years. So let's go 10 years forward when the bond, this 3.25% taxable bond, becomes callable. And it still has 12 years remaining to maturity. And let's look at the situation then. And so first of all, we look at it from the issuer's perspective. The issuer is looking at a bond. It happens to be taxable, but you can refund it. It's a tax-exempt bond, and the relevant 12-year rate, let's pretend it's 2.87%. So you're looking at calling and refunding a 3.25% bond at 2.87%, and you find that if you're looking at savings, the PV of the cash flows is almost 104. You can call it at par, and so you would probably call it and save about 4 points. Sounds like a good deal. But now let's look at this same bond from the perspective of an investor. Pretend that you are holding this bond. You are the investor. You're holding a 3.25% bond. It's callable at par, and the tax-exempt rate happens to be 50 basis points above the 2.87%. So the tax-exempt rate is 3.37%. Well, you immediately see that this bond is going to be selling at a discount. It would sell at a discount as a bullet, and the price is depressed even more if because it's callable. So the price would be 98, and it's being called at 100, which is a good deal. And this is the story I wanted to share with you. So these taxable munis could be called at par when their actual taxable value is below par. Okay, and let's wrap this up. Go to the next one. All right, I've told you the takeaway. There's value in these callable taxables because they may be called when their taxable value is below the call price. The analysis is complicated, but when everything is said and done, the question is how much value is in a typical long-term taxable muni, which will be refunded probably with a tax-exempt bond. And the number is somewhere about 1.5 to 2 points. And that's the bottom line of this presentation. There are some papers. I published a couple of papers in short pieces in the bond buyer that you may have seen. And I have another long, more scholarly paper coming. I would be happy to send you. And finally, let me just, Ian, if you could go to the next page just to show you some analytics. There are some demos at our website that you may want to look at. And in particular, I recommend this bond OES demo because you see the speed. There are about 3,000 callable agency bonds, and you'll see that you value those well under half a second. And I would also suggest you look at the Muni OES demo because it shows you the type of errors that you make if you use conventional analytics to determine the duration and the spread and other risk measures for discount munis. Don't account for the fact that the value of these discount munis is depressed by the de minimis effect. So thanks very much. If you have any question, contact Mike Palmieri, my colleague, or send me an email. Thanks so much.
Thank you, Andy. That's very interesting. There are a number of questions that came in while you were presenting, but as I said at the beginning, we'll save those until the end, and so we'll try to answer as many of those as we can. So our next presenter is Unmesh Vida, who is Managing Director, JP Morgan Pricing Direct, and Unmesh is going to talk a bit about pricing of municipal bonds, specifically using machine learning. So Unmesh, I think I'm running the slideshow for you here. So just give me a shout when you want me to move the slides on, and I'll happily do so. But over to you for the presentation.
Okay, thanks, Ian. Just as a background, JP Morgan Pricing Direct is a valuation service, and we provide valuation for fixed income, both taxable and non-taxable, as well as for derivatives. So Ian, can we go to the next slide, please? So in general, artificial intelligence has revolutionized the world around us. Specifically in the financial industry, including JP Morgan, there is a tremendous focus on deploying AI-based system to achieve superior financial results. So one of the things that we did here was, we know machine learning, which is a branch of AI that is very good at processing the big data. Munispace is a good example of big data, as we all know. For example, we know in munis there are about 50,000 issuers, about million plus number of bonds. So from a data processing perspective, it's a huge amount of data that you need to process. The other thing that we know in the muni space, some of the bonds would not trade after they are issued. There are certain bonds that are traded more as a benchmarks, and some are not traded for a long time. So there is obviously pockets of liquidity and pockets of illiquidity. So from a challenge perspective, it's really how do you build the framework around pricing a million plus bonds on a daily basis, maybe multiple times. So that was the kind of challenge we were looking at it. So what we did for that is we took the muni universe and kind of looked into two parts, right? One is your investment grade bonds, and then the other one is the high yield bonds. The reason we broke down is in case of high yield bonds, it's really a lot more based on the story bonds, I would call it, where there is a lot more credit analysis has to be done, or there is a lot more digging into certain things. For like for example, Puerto Rico bonds or some of the more detailed credit oriented bonds. As opposed to in the investment grade bonds, the way we took we looked at three types of bonds. You have a GO, you have revenue, and a BAP. And then we took that further into like we have 50 states. So we broke down into three categories in terms of model perspective. And the way it was done is we are creating a cohort that is as close to corresponding bonds. So obviously, just as an example, our third tier was really like a New Jersey and Illinois as an example, and the other other 48 states were in the top other two tiers. And the way we looked at it is, okay, now we have this tiering. So we have a three models in terms of geo, revenue, BAP, and then you have three other tiers if you want to look at. So we had basically about 9 different models that we were working on to kind of price this universe. Now, by adding the munis, we basically doubled the number of bonds that we cover. So we went from 1.2 million to about 1.4 million range, 2.4 million in terms of the number of bonds that we cover. Now, in terms of machine learning perspective, what is more important is we use what I would call a more supervised learning approach, where we are understanding what is involved in terms of what features of the bonds are very important when we are doing valuation. So it's really a combination of machine learning as well as evaluation approach together. And in that specifically, as Andy was talking before, one of them is a coupon, like 5% coupon versus a 3% coupon. They trade very differently. And then also we look at more like your typical call schedule, the put schedules, obviously the ratings. The other part also you have to look at also is the tax structure. So it's a partial tax exempt, fully tax exempt, those kind of things. We were also looking at a shape of the yield curve. We were looking at in terms of like the funding stress. I mean, we'll talk that more further, like as we go into the future where evaluator add more value. So that was kind of the high level. Like we have about 30 different features in our Muni model, and one of the feature is like a shape of the curve. Or we are also looking at where the LIBOR is as an example. So those are the kind of very high level features of our Muni model. Ian, can we go to the next slide, please? Thank you. So if you look at in a high level sense, the machine learning versus a human approach. If you look at just the traditional human approach, where you have a 30, 40 people evaluating Muni market, and you're trying to look at a portfolio level, like certain sectors and certain states. And then you're trying to analyze these bonds. As opposed to when you're looking at from a machine learning perspective, now what you're trying to do is, okay, I have a Texas bond versus I have a bond in New York. What are the similar characteristics, and how can I exploit the characteristics that are common? If you think about it as a human, our thinking capacity is not as great when you're trying to think through like a 30 dimensions across million bonds. So the capacity that machine learning brings to is like the more holistic approach, where you're looking at the whole universe and what are commons. And that is another part that we are doing, is when we are going through this testing, we were adding more features to see what makes sense. Again, the other part, importantly, while we're going through this 18-month of testing and improving our model, was we were not trying to just create a dummy variables, if you want to call that way. What we wanted to look at, does that variable make sense from a financial market perspective? What does that explain in real life? And what is that bond feature or a curve feature or the market dependency makes sense? So that was a important aspect. I'll give another example in that sense is, for example, traditionally in muni market, where always we look at is like how much a richer your curve is to the treasury market. So like that is always referred as a ratio. And if you look at, typically that ratio used to be, let's call it 75% to 90% range. Now, if you look at right now, your 10-year treasury is about 70 basis points, as opposed to your 10-year AAA muni curve is, let's call it in high 90s, like 95 to 98 basis point in that range. So if you think about it, it is actually higher than that. So if you think as a one of your dominant variable in your explaining the in the model, that will have a problem. The other important aspect is also every machine learning model has its own limitations. So what we wanted to make sure is we wanted to have a human approach added to that. So it is not a totally machine all the way. It's a really a superior combination of a human plus machine learning together. So that's kind of the approach we looked at it. The reason for that is, for example, when you're doing a machine learning model, the data that feed you, that is as good it can get. Now, really on the each day, for example, there is no new issuance happening. There is a certain geopolitical event might be happening. So those are the things that you need to incorporate on the top of what machine learning model might explain. On the top of that, if you think about in the recent COVID-19, if you look at it, there was in the middle of March, you were thinking about there were a lot of liquidation, there was a lot of funding stress. So you need to make sure you have additional variables who are actually capturing that conceptually. So you are trying to look at not just the fundamental side, but more from a supply and demand side, and how you're actually capturing that funding stress in that particular manner. The other thing that we also look at is in terms of new issuance, like what sectors that are happening. Now, as I mentioned before with COVID-19, now certain sectors, for example, if you look at airport bonds, if you look at your hospital bonds, or for that matter, or higher education bonds. So these are the certain sectors obviously are not doing well. So you need to kind of keep an eye on it now, the widening of those spreads versus your a typical geo bond. So that those are the additional things that a human add to that things. So if you think about it, so the way we looked at this is like we have seven members in our team, and we work on that to kind of see from the market perspective as well as from a machine learning perspective. And one of the things that we've done here is within the team, we have a machine learning expertise along with the muni market expertise, and we are trying to basically marry those skill set and to produce a better evaluations. The other things that we noticed was when we are developing these models, one of the things that was very important was how much time it takes to build this, to run this model and train the machine learning models. So one of the things we was looking at it was, we had to actually go to GPU network to actually make sure we are able to meet our SLAs in terms of delivering the data. So that's another things you need to do that. So that's where we are actually able to use our JP Morgan infrastructure leverage to get it done, because it's much faster to run that. So if you look at from the diagram perspective, that's where you have a combination of the skill set. Then we do, again, the controls are very important, and in the sense of we, like in general, pricing direct has SSA 18. So we wanted to make sure we have a full controls in terms of how we are doing the QC of the pricing, and then we are providing the output to the clients. So that's on like a high level basis. Ian, can we go to the next slide, please? So other important part within the machine learning is really, in sample versus out of sample. Because if in some cases I mentioned earlier that we have 30+ features, if you add more features, it's some of the times that you run into problem is overfitting the model, where what that means is you are training for a training data set, the model looks excellent, but when you try to go out of sample, at that time your results are not that good. So you have to always find the balance between overfitting versus underfitting. And if you look at the data, so what we have plotted here in the things are, on the left side is the model price versus trader price. On the top graph is and that is with the in sample, where we had R square of 99.8%, and for out of sample is about 99.5%. So you can see they are very much in the context of each other. The other part you will notice here is we wanted to make sure we are looking at all type of bonds. Like I think, as Andy was mentioning before, the discount bonds behave very differently, like say $50, $60 price bonds versus the bonds which are $150, $160 price. And one of the things we were doing that for is obviously we are using the MSRB color. We are also using the color from our trading desk as well as other market participants. So we are trying to use the information that is coming from various sources as well as like a new issue perspective. And then the additional part on the top of that on that day is the geopolitical events. So that's how together we kind of put this evaluation process together. And we do on a daily basis go through this back testing to make sure are there any outliers, and this is a more like a feedback loop that we do on a daily basis. So that way we can look at what are the shortcomings are, what can be improved, and that's kind of the on a higher level the process works. Thank you, Andy. Thank you again. And if you want to, this is our contact information. So if you want to reach out to us, please reach out.
Thank you, Umesh. That's very interesting. I've got a few questions, but we'll deal with them at the end as we will with those. So thank you very much indeed. And our final presentation today is from Robert Kane, who's the CEO of BondView. Robert's going to talk a little bit about liquidity risk and the index products from BondView. But also, I think, Robert, you're going to do a little bit about some which Umesh actually referenced, was the impact on some of the sectors from COVID-19 as well. So, Robert, you have the controls, as they say. So we'll hand over to you. You're going backwards.
Okay. Good morning, everybody. Okay. So today we're going to talk about muni bond data and analytics, which is a topic near and dear to our hearts. We've been involved in big data and algorithmic analysis of the muni bond industry for since we got into this about 10 years ago. And so we're going to discuss. Let me just click. Just trying to click ahead here, Ian. Okay, the three topics we're going to cover today are, first, will your muni bonds survive COVID-19? And BondView is just about finished with creating a new COVID-19 impact rating, which looks at the default risk and economic impact of the pandemic on all muni bonds. All 1.3 million bonds are being evaluated now. Secondly, we're going to talk about a new liquidity-based municipal bond index called the BondView 500, which basically looks at the most highly liquid bonds that are most widely held by funds and actively traded. And third, we're going to discuss how to get a second opinion on your fund's liquidity assessment as it relates to SEC Rule 22E4, and that's the whole bucketizing and identifying illiquid assets that are held in funds, and specifically muni bond funds. So let's jump in. I'm just trying to move ahead here. Oh, here we go, BondView. So we've been in business about 10 plus years. We do daily evaluated prices on all 1.3 million muni bonds. We also perform daily liquidity assessment on 2,400 muni bond funds. We look at their holdings and we identify that bucketizing concept, the highly liquid and illiquid. And we also, with the BondView 500 index, we brought out late last year with the first index that's based on liquid, actively traded, widely held bonds. And then to the right, you can see we have basically, if you know muni bonds, you probably know BondView, and we have a lot of different customers. And here's a list of some of them. And moving on, thank you. Maybe Ian, you're helping me do that. Thanks.
Yeah,
Thank you. So COVID impact ratings. Will your municipal bonds survive COVID-19? So there's the obvious expectation that states and cities are going to experience a negative economic impact. And we read about it almost every day from analysts, news media, even rating agencies, of course. But how do you know if your bond is potentially infected? And so with the rating agencies' ratings being stale currently because there's so many issuers out there that would need to be re-rated, they just can't keep up. So you can't rely so much on ratings. It's also difficult to check the market's pulse on a particular bond since only about 1% of munis trade on a daily basis. Chances are your bond is not trading that you might be interested in. So how do you test if a bond is potentially infected? And next slide, please. So our rating is based upon multiple factors, which again, we're reviewing across 1.3 million munis that are outstanding. So we are, much like what Unmesh was discussing, that there is a people component in this analysis, these ratings. As much as we'd like to have ratings be quantitative and algorithmic in the BondView world, there's definitely a people component. And so we already know that there's some sectors that are affected today. There are several, but as an example, the travel and leisure sector, airlines, convention center, hotels, stadiums, etc., are all being impacted. For instance, at LaGuardia Airport here in New York, Delta Airlines was involved in building a new terminal. They're the obligor for the bonds that were issued. There's very few people flying airlines, let alone Delta, these days. So the question is, will they be able to pay back those bonds, and will they technically default in the short term? And then at the other end of the spectrum, you have nonprofits who have difficulty fundraising in the future because there's less money around, and their investments may have got impacted as well. So that's the qualitative component. And then we're examining across 1.3 million bonds, again, the material events that have been disclosed for each and every bond. Like technical defaults or indications that there's a question as to what the impact may be on COVID. There's about 6,000 issuers that have filed letters like that so far. Then we look at BondView's own internal market implied rating, which is we take the price last trade of the bond if it's recently traded, and we compare it to similar bonds in the same category to identify, we look at the spread over treasuries and AAAs and compare that group of bonds to your bond. We come up with a rating. Now that market implied rating is very often an early warning indicator that the marketplace senses that there's a problem with the bond. So if similar bonds are trading at par and your bond is trading at 80 or 75, and there's no rating indication as to why, or no disclosure as to why that's happening, often that's there's something else going on in the news maybe that just hasn't been all correlated. And then the last two categories we look at are liquidity assessment. We look at trading volume and fund holdings and who's dumping what shares. And then we talk to industry experts. In fact, if anybody out there is interested in chatting about this, please contact us with your comments. And this is a product, tool, service offering, call it what you like, it's going to be available in the next 30 days before the end of the quarter. So next slide. This is one of our screenshots of a particular bond, and you can see here, this is a COVID impact rating that the user would need to drill down to get more details about, but we are trying to get the message across and communicating with a graphic. But okay, next slide. All right, and then moving right along to a second topic is the BondView 500 index, which is a new liquidity-based muni bond index. So it's liquid in that the bonds that are in the index are easy to trade in and out of without a significant discount to the current marketplace. The spreads are tight. The key feature of this index is that the bonds are widely and deeply owned by professionally managed funds. And the theory is that the 2,400 muni bond funds that are out there employ smart credit analysts who review risk prior to putting a bond on its buy list to allow the fund manager to buy into those bonds. So we get to look over the shoulders of those analysts and their purchase decisions by the portfolio managers by just looking at the public filings. We consolidate all that information together, and that we share that information. It kind of all bubbles up in the index, and we end up with 500 bonds that represent 1.3 million. In a way, there's a ratio of what we represent. I think it's about 35 billion is represented in those 500 bonds in terms of outstanding. And then we also track. There's a notion of the most actively traded based on last 90 days volume and bid-ask volume. But at the end of the day, those 500 bonds in the BondView index, which are updated monthly and available for anybody to see today, it's a curated list of muni bonds that are just naturally easier to buy and sell. So as an example, if a New York bond, a New York GO, is held by 70 funds to the tune of 500 million, and it traded in the last 90 days 100 million is worth, and funds seem to be actively buying it rather than selling it, and it's available for sale today, that's a better bond to buy than the opposite, which would be a bond that's not held in any funds, is not actively traded, maybe not rated. The list goes on. So the question is, in the retail and financial advisor world, do those folks know that which bond they want to be buying, which is an easier bond to buy or sell? And next slide, please. So the BondView index is transparent. We publish all the characteristics daily, which is different from other index vendors who kind of keep everything more closed. You can drill down on the BondView platform. You can see the complete bond description details of every bond in the index. It's an equal weighted index, which is important, so we're not skewed by any large holdings. And it's inexpensive in terms of a fund that's looking to implement this, or where you have other subscribers that just want to know what's in the index and why. So it's it's about $90 a month or so. Next slide. And we're going to look at a couple of screenshots. So this is the BondView 500 Liquid Bond Index. It's on our site. You can just go right to bondview.com and click this. And so basically, here's a list of bonds, and we look at actively traded. Turn on my marker. Amount for sale in the last 3 days, amount held by funds, number of funds holding, so you can tell if a fund is widely held. Okay, next slide. Drilling down a little bit, you can see this is on the BondView 500 index as of yesterday. This is the number 3 position. That's Hudson Yards Infrastructure Bond in New York. And as you scroll across the column, you can see some characteristics of the bond, and then you can see that in the last 90 days, 235 million was traded. There was about 7.8 million for sale in the last 90 days offer for sale. 79 million are held by funds, and 59 different funds own this bond. So that's a super liquid, easy to buy, easy to sell. Well, definitely easy to sell bond. You know, some of these bonds are not so easy to sell because no one wants to sell them. Next slide. Oops, good one. Let me just go back one. Apologies for the, I'll go forward one. It's like a delay. Okay, and then the third topic we're going to talk about, and I know I'm moving pretty quickly, but is how to get a second opinion on your fund's liquidity assessment. And this has to do with the SEC Rule 22E4, which has been in place just for the last year plus, and it requires all funds, not just mini bond funds, but to all funds to evaluate their highly liquid and illiquid holding is really what they focus on. They don't want, the SEC wants to know if more than 15% of a fund's holdings are illiquid. And the way this is rolled out in the industry is that most funds receive a liquidity assessments service offering from their fund administrator. It kind of comes included with the fee that they pay for the fund administration. And the problem is that many fund managers don't always agree with the methodology or the results from those assessments. And that causes issues with their compliance department saying, you know, why are we out of compliance? Why do it seems we have more than a 15% illiquid rate? And a portfolio manager may say that's not true. So what we offer is an affordable second opinion. It's also difficult if you want to look at, we have some subscribers that are financial advisors that sell funds across different fund families, and they want to know about investor suitability for a particular fund relating to the folks that they're selling to. And in this volatile market, it's hard to know how illiquid a fund may really be. So what we've done is we look at all 2,400 mini bond funds, and we have a database that basically is available. You can look up any fund to see its liquidity. You can drill down in detail to see that. Fund competitors are interested in that information. Financial advisors reselling funds are interested in that information. And just funds themselves, the primary funds are interested in knowing if their assessments are accurate. And just to have a quick screenshot of that. So this is the high-level summary page of the high-yield muni sector, the peer group, and this is from yesterday. And on the left, I've magnified the listing that we're sorting this by total fund value. So you know, Nuveen, Invesco, Goldman, et cetera, these funds and their corresponding liquidity assessment is listed across the page here. This is the highly liquid amount that we estimate. But as you roll over to the end, you see this is the illiquid percent. And it's in red because anything more than 15% is a red flag for the SEC to be aware of anyway. And so the Nuveen high yield mini bond fund we're estimating has about a 35% of the holdings are illiquid, and et cetera. You can see down the row. The high yield market has, the peer group has its fair share of funds that we estimate are above 15%. And let's see, then you can also drill down into each fund to get a clearer answer whether their liquidity is sufficient or not. Maybe a little difficult to see this, but this is a pie chart showing the illiquid amount, and then you can see each holding within the fund and the methodology used to analyze whether that holding, as to that holding's liquidity assessment. And so we look at things like what size their position is, other funds' capacity to buy, and how illiquid that position may be. And just a note is that this is our methodology, and each fund may have a different methodology that they employ. There also may be credit lines in place that we're not aware of since we're working off publicly available filings. But in any case, this does give a pretty good handle on information. And let's see, next slide. And that is it for me. I know we're running out of time, so Ian, I'm going to just throw it back to you, but you anybody can get in touch with me at the email below.
That's great. Thanks, Robert. Yeah. So we do have about sort of 5 minutes left for questions. So I have got a few here that I know you'd like to see answered. Anything we don't manage to get around to in this session, we'll try to answer offline. So the first question is actually for Andy. So Andy, I hope you're still there. And
I'm here, Ian.
yeah. So the first question was relating to the sort of other ideas you put forward on the taxable carbon munis. And the question was, are you seeing any of this activity in the market at the moment, or is it still just a like a theoretical thing that you guys have put forward? I know you've been talking about it for a few months, but are you actually seeing any of this happening yet?
Well, what we see is the prices of these new taxable bonds, and in our opinion, they are not priced properly. I don't think the investors distinguish between callable taxable bonds, which are refundable by taxable bonds, and those which are refundable by tax-exempt bonds. So the short answer is no, we don't observe it. I think there is a big opportunity for those who wish to invest in taxable munis.
Right.
I think these callable taxable munis are preferable to the bullet taxable munis.
So something for all you funds out there to take account of, right? The next question is for Unmesh. Unmesh, the question relates to machine learning, and the question is, does in your experience, does the machine learning technique produce superior results to traditional evaluation techniques?
I mean, we have obviously used machine learning in other products also in terms of gathering the data and all. And I would say the capacity of machine learning is much better than a traditional approach, I would say.
Okay, thank you. Robert, the next question is for you. Relates to the Bond U 500 index, and question is, how has the index performed over the last few months during the height of this crisis?
Right, thank you. Actually, it's performed well, relatively speaking, in the sense that the index is filled with bonds that are very easy to trade, and so therefore the spreads are thinner for those bonds that investors are trying to sell. So the index has, I mean, actually I have the stats published on our website on its performance, but we definitely performed better than MUB, the iShares National Muni Bond Index during the same period. We're basically down, but down way less. I don't have the actual data in front of me.
Thank you. Yeah, another question for you, Andy. The scenario you painted on the taxable bonds situation at the moment in terms of refunding, I'm guessing relates to current market conditions, right? So how have you looked at how this might work in the event that interest rates were to rise? I know that seems like an unlikely scenario at this stage in the game, but particularly for investors rather than issuers.
Well, we've got a long way to go here because, as I mentioned, currently you look at these taxable bonds and they are issued around the 3% level, 20-year maturity or so, and the bonds being refunded have coupons 5%. So in general, rates could go up by another 100 basis points, and right. I believe we continue seeing these.
Yeah. Good, thank you. Unmesh, another question for you. Just talking a little bit about, there seems to be quite a lot of interest here on the whole machine learning approach. So you've obviously hit a particular chord here, but you mentioned that there were some limitations to machine learning, which necessitated using a human element in there as well. Can you just summarize again what those limitations might be?
If you look at the machine learning approach, it only looks at the data you fed into the training of the model. So if there are any new things that happen which is out of sample, then those dimensions that are not captured by the model. So it's really that's where I was mentioning before, was if there is a new geopolitical event or new tax law, or that happened today, or something is now approved by a state house for a certain state, you need to kind of capture that, because the old training data might not capture that. So that's the limitation. And it's really how you overlay the new information onto the model.
Thank you. And just one very quick final question for you, Robert, which is that when is the COVID-19 marker going to be released? Do you know?
Yeah, it should be out by mid-June, so just a couple of weeks away, and so that's the time frame. Just to circle back to your last question, in March, the iShares National Muni Bond Index was down about 15% plus or minus. The bond U index was down 3.5% during that same period. So, as an indicator.
Okay, good. Well, we sadly we've run out of time. I think all it remains for me to do is to thank all of our presenters today. I think you'll agree that it was an extremely useful and informative session. Thank you all for attending, taking an hour out of your day and listening to us today. And we hope to see you again at our upcoming webinars. As I mentioned before, as a piece of housekeeping, anybody that's registered to attend the event will receive a copy of both the slide deck and a recording of the webinar tomorrow. So thank you very much again, everyone, and good afternoon.
Good afternoon.
Thank you.